Imagine waking up and finding out that billions of dollars worth of gold have quietly been pulled out of the financial system. Not just paper promises, but the real metal, moved, delivered, gone. That's exactly what's happening right now. More gold is being demanded for physical delivery than at any other point in recent history. And the numbers are staggering. For decades, less than 1% of gold contracts on major exchanges were ever converted into actual bars of gold. It was always easier, cheaper, and faster to settle in paper. But now something has changed. Instead of 1%, nearly every contract is being settled in physical gold. We're talking about millions of ounces worth billions of dollars leaving the system. Think about what that means. It's as if people no longer trust paper IOUs or electronic balances. They want something solid. They want something real. They want gold in their own hands. Here's a simple way to picture it. Imagine you bought a gift card at a store. In the past, most people were happy to use the gift card as credit and never bothered cashing it out. Now suddenly, everyone is demanding actual cash for their cards. Not only that, they're taking the cash out of the store and walking away with it. That's what's happening with gold. This isn't just a statistic buried in financial reports, it's a signal of what's to come. When people with billions at stake are choosing gold over paper, they're telling us they don't trust the system the way they used to. And when trust in money starts to erode, everything changes. Savings, investments, and even the way countries trade with one another. If more and more investors keep taking gold out of the system, the question becomes clear. What does that say about the future of the dollar? Now let's talk about a plan that could completely reshape how the U.S. government borrows money. It's the idea of issuing bonds that are directly linked to gold. Here's how it works. Normally, when you buy a U.S. Treasury bond, you get interest over time and your money back at maturity. But imagine a bond that pays zero interest. Instead, at the end of its term, you can redeem it for actual gold. No coupons, no percentages, just gold itself. Why would anyone buy such a bond? Because gold doesn't lose value the way paper money does. It acts as both an inflation hedge and a guarantee of real purchasing power. In effect, gold itself becomes the interest payment. Think of it like this. If inflation eats away at the dollar, your regular treasury bond may give you back money that's worth less than what you started with. But a gold-backed bond gives you something tangible. Even if the dollar weakens, your claim on gold stays the same. For the government, this setup has another advantage. By tying bonds to gold, they can attract buyers without having to raise interest rates. In other words, the debt looks safer because it's tied to something real. And safer debt means cheaper borrowing costs. Now consider what that would mean for everyday people. If the U.S. shifts to a system where bonds are backed by gold, the financial landscape would change overnight. Savers might choose these bonds as a more secure option. Investors could treat them as both a safe haven and a hedge against inflation. And the rest of the world would suddenly have a reason to trust U.S. debt again. This isn't just a theory on paper. It's a strategy that could reset the entire foundation of the dollar. And if such a move happens, it wouldn't just affect banks and governments. It would affect your retirement account, your mortgage, and even the value of your paycheck. The big question becomes, if the government ties debt to gold, are we heading into a new monetary era or the final stage before the dollar loses its place as the world's reserve currency? To understand where this could be heading, we need to look at stablecoins and why they're becoming such a big deal. A stablecoin is a digital token that's supposed to hold the same value as the US dollar. People use them to move money quickly without banks slowing things down. But here's the twist. More and more stablecoins are being backed by US treasuries. That means every time a company issues new stablecoins, they have to buy treasuries to support them. This creates new demand for government debt, even when natural demand might be falling. It's like giving the government an artificial buyer to keep the system running. Big banks are already stepping in. JP Morgan recently connected its customer rewards points to stablecoins. That's not just a gimmick, it's the first step toward merging everyday financial tools with government bonds. Imagine converting your credit card rewards directly into a digital coin backed by treasuries. That's where things are heading. On the surface, this looks smart. It keeps the US Treasury market stable in the short run. It gives banks new products to sell, and it makes digital dollars feel secure. But there's a catch. This only helps on the short-term side of debt, the bonds that mature in a year or two. It doesn't solve the longer-term problem of trillions coming due in the next few years. The system starts to look like a car with a brand new engine in the front but a cracked frame in the back. It runs for now, but the foundation is still weak. The question is simple. If stablecoins keep the short-term debt market alive, what happens when the long-term debt comes knocking? To see why this matters, You need to understand what it means for the dollar to be the world's reserve currency. Right now, most international trade is settled in US dollars. That means countries everywhere need dollars to buy oil, food, and raw materials. To get those dollars, they sell their own currencies and buy ours. This drives up the value of the dollar and keeps our borrowing costs low. It also creates what's called Triffin's dilemma. The country that issues the reserve currency always runs a trade imbalance. Why? Because to supply the world with enough dollars, the US has to print more than it would otherwise need. That makes imported goods cheaper at Walmart. It keeps interest rates low for mortgages and loans. It keeps asset prices high, but it also ships manufacturing overseas. If dollars stay strong, it's cheaper to make things abroad. Factories move out, jobs disappear, and the US becomes more dependent on imports. Now here's the shocker. Some policymakers are starting to say that being the reserve currency might not be good for America anymore. Losing reserve status could actually help bring back industry. It would make our exports cheaper. It would make domestic production more competitive. But it would also make life more expensive at home. If the dollar falls, imports cost more. Everyday goods go up in price. Trips abroad cost more. The stock market could suffer. But American factories might roar back to life. This is the trade-off. Stay the world's banker and sacrifice industry. Or give up the crown, rebuild manufacturing, and accept higher costs of living. The real question is simple. If the dollar loses its place at the top, how will you protect your savings when the balance shifts? Now let's dig into what could happen if gold itself is revalued. Right now, gold trades in the low thousands of dollars per ounce. But many analysts believe it could be reset much higher. 12,000, 15,000, even 24,000 per ounce. Why would governments do this? Because by raising the official price of gold, they instantly devalue the dollar. And when the dollar is devalued, debt becomes easier to manage. Here's how the math works. Every $4,000 increase in the price of gold gives the U.S. Treasury trillions of dollars in new accounting room. By declaring gold is worth more, they can create money out of thin air, backed by that higher value. It's like changing the rules of the game by making each point worth more. Central banks all over the world would benefit. They've been quietly buying gold for years. If the price shoots up, their reserves suddenly look much stronger. This strengthens their financial position overnight. But for regular people, a dollar devaluation means the opposite. Your paycheck buys less, groceries, gas, and rent climb higher. Savings in the bank lose purchasing power. The only winners are those holding assets that rise with inflation. And history shows gold and silver lead that pack. If such a reset takes place, the world financial system would look completely different. Every central bank would hold more power through their gold reserves. And the US dollar would no longer be the unchallenged leader. The takeaway is clear. If gold is revalued and the dollar is cut down, those who prepared with real assets will be shielded. Those who didn't will feel the full weight of the reset. So the question becomes, if the scoreboard is about to be reset, are you sitting on points that actually count? A weaker dollar and gold-backed bonds could open the door to a major shift in the U.S. economy. One of the biggest goals behind this move would be to bring manufacturing back home. For decades, strong dollars and cheap overseas labor pushed factories out of the country. Clothes, electronics, and even medicine were made abroad because it was cheaper. That left America vulnerable. Supply chains broke down during the pandemic. Critical industries like microchips and pharmaceuticals became dependent on foreign suppliers. Now add a new factor, artificial intelligence. AI is set to replace many white-collar jobs. Customer service, data analysis, even parts of finance and law are at risk. That leaves millions of people needing new kinds of work. But 60% of Americans don't have a college degree. They can't all transition into coding or advanced AI roles. Where can they go? The answer is back to making things. Factories, plants, and production lines. Jobs that don't require 4 years of school but still pay a steady wage. A cheaper dollar would make U.S. goods more competitive overseas. Zero-interest borrowing tied to gold would make it affordable for companies to build new factories here. That combination could fuel a new industrial era. Imagine walking through a Midwest town where the factory lights had been dark for 20 years. Now those lights switch back on. New jobs are created. Local economies revive. It's not just an economic move. It's social stability. But this won't happen without cost. Imported goods will become more expensive. Living expenses will rise before wages catch up. Families will feel the squeeze. This is the trade the system is preparing to make. Sacrifice the dollar's global dominance to rebuild strength at home. The question is whether households are ready to ride out the pain before the benefits appear. So you need to ask yourself if the jobs of the future are moving back to factories, Are you and your investments ready to move with them? While gold gets most of the headlines, silver is quietly waiting in the background, and many believe it's the most undervalued asset in the world today. Silver isn't just money, it's a key material for technology. It's used in solar panels, electric vehicles, medical devices, and electronics. Every modern economy depends on it. When gold rises, silver usually follows, but because silver starts from a much lower base, its gains can be even more dramatic. A small increase in gold's price can trigger a much larger percentage increase in silver. Think of silver as gold's younger sibling. It doesn't always get the attention, but when the family name rises in value, the younger one races to catch up. For everyday investors, silver is also more accessible. You can buy several ounces of silver for the cost of a single gram of gold. That makes it easier to build a meaningful position without huge amounts of money. There's also a practical side. If you ever needed to use precious metals for trade, silver is more flexible. It's easier to exchange a small coin or bar than to break apart a large gold piece. The signs point to silver being overlooked today but essential tomorrow. And history shows that when gold goes parabolic, silver doesn't just follow, it often outpaces it. The real question is simple. If gold takes off, will you already have silver in your corner before the crowd notices? If all of this feels overwhelming, the best response is to focus on simple, practical steps to protect your wealth. First, diversify into assets you can hold in your hand. Gold and silver coins are a starting point. Not just large bars that are hard to trade, but smaller, flexible pieces. 1-ounce coins or even half-ounce coins can give you options when you need them most. Second, don't put everything into one type of coin or bar. Mix between government-issued coins like American Eagles and more affordable options like maple leaves or kangaroos. This way, you balance recognition and liquidity with better pricing. Third, think about flexibility. If all you own are large gold bars or 1,000-ounce silver blocks, you might find it hard to use them in a crisis. Smaller denominations make it easier to sell or trade when you need quick access to cash. Fourth, treat metals as one part of your plan, not the entire plan. Precious metals protect against currency risk and inflation. But stocks, real estate, and productive businesses create growth. Balance both protection and growth in your strategy. Fifth, stay liquid. Don't lock up everything in assets you can't touch for years. Have enough cash or short-term investments to handle emergencies without being forced to sell at the wrong time. Wealth is about options. And the more options you give yourself, the stronger you are in uncertain times. The real question is this: if the reset comes tomorrow, would your financial life give you choices or leave you stuck? Here's another layer to this story that few people like to talk about. The idea of a reset coming in two stages. One man-made, one driven by nature. The man-made reset is what we're seeing unfold now. Policies, currencies, stablecoins, gold revaluations. These are decisions made in boardrooms and government offices. They try to control the outcome, but history shows man-made resets rarely work as planned. When that fails, the second reset begins. The one driven by nature. Markets, resources, and global power shifts that no one can stop. When this stage comes, governments act quickly to protect themselves. History gives us a clue. In 1933, the U.S. government forced citizens to turn in their gold. People were compensated in dollars, but at a price set by the government. Soon after, the official gold price was raised, leaving ordinary citizens on the losing end. Could something like that happen again? Some analysts believe yes. If things get desperate, the government could confiscate assets not made or minted in the U.S. Foreign coins, bars, and bullion could be targeted first. That's why many experts recommend focusing on U.S. minted coins like American Eagles and Buffaloes. They're recognized, trusted, and less likely to be restricted in a crisis. This isn't about fear, it's about being realistic. When systems break, governments look out for themselves first. And history shows they rarely protect individual savers in the process. The real question becomes clear. If the rules change overnight, will what you own still belong to you? Or will it be taken away with the stroke of a pen? Is this conversation helpful so far? We've walked through a lot. Gold deliveries surging out of the system. Ideas of bonds tied directly to gold. Stablecoins creating artificial demand for U.S. debt. The dollar's global role being questioned. The possibility of gold being revalued to levels most people can't imagine. And the push to bring manufacturing back home in a world where AI is changing white-collar work. All of this points to one reality. The financial system is shifting under our feet. The dollar we've relied on may no longer be the same dollar in a few years. and the assets that feel safe today could be worth far less tomorrow. So what can you do? Build protection with real assets. Hold some gold and silver. Choose flexible forms like coins that are easy to sell or trade. Diversify across different types of investments so you're not exposed to a single point of failure. Stay liquid enough to ride through shocks without selling at the worst possible time. And think in decades, not weeks. Wealth grows by being patient and prepared, not by chasing headlines. The passive path is all about finding ways to protect and build your wealth without gambling your future. That means being aware of changes like these and acting before the crowd does. So here's the takeaway. Don't ignore the signals. Don't assume the system will always work the same way it has. And don't wait until prices explode before making your move. Preparation is what separates survivors from victims. If you found this valuable, make sure to like this video. Subscribe to The Passive Path for more strategies on protecting and growing your wealth. Leave a comment with your thoughts and share this with someone you care about. Stay prepared, stay focused, and I'll see you in the next video on The Passive Path.